Hey, and welcome to TSOB. This is a podcast for entrepreneurs who are interested in investing or starting their own funds. We are Adam Anderson and Zach Eikenberry. Join us to get a behind-the-scenes look at the relationships between founding entrepreneurs and the VCs that invest in them. Ladies and gentlemen, boys and girls, welcome to TSOB, where we cover everything from A to Z regarding the financial systems of businesses and startups. I'm Adam, he's Zach. That's why it's A to Z. It's not that we're fully inclusive or understand exactly what we're talking about, but man, we speak with authority, don't we?
Absolutely. That's why I show up every day.
Yeah.
I make it, therefore I fake it. That's right.
Now there's a tramp stamp. Well, you know what? Moving on. Hey, you've been on adventures. I've been on adventures.
Mm-hmm.
But it's been a deep thinking week for me. But before we dive into stuff, I know I want to talk about different kinds of investors. I want to talk about down markets. You sent me an article that was fascinating and blah, blah, blah. But I think that if we can do one thing, I want to hear about your adventures in Miami. Can you set the stage and tell a story?
Yeah. So I'm a fan of another podcast that emerged during the pandemic called the All In podcast. It's hosted by four gentlemen who are in the startup and VC world, capital allocators. And they have a very interesting camaraderie point of view, but also they've created a podcast space where they can disagree. And so they've attracted a number of people who would be very drawn towards open and, free speech environments where they can speak out on different things. For good or for bad, that's fine. But you'll find that there's an interesting niche out there among capital allocators who want to be able to share their point of view without concern about the latest politics. And even though a number of the discussions are political, there was even a point counterpoint debate on Ukraine at this debate or at this conference, whether or not we should be intervening and how we should or should not be. And it was a very interesting conference on that regard. So it was very heavy. It's probably the only conference I've been to where I attended every session.
Wow.
And I actually skipped some of the parties, even though the parties were a lot of fun. I didn't partake all the way through. I ended up not feeling very well towards the end. But
that's the exact opposite of LobbyCon, where the best conversations are happening in the hotel bar and in the lobby, and you actually went to all of the. That's pretty cool. How many people were there? Do you think?
I think they said there was between 600 and 700 people.
Oh wow, that's almost too much.
Yeah, they originally were around 500, but they just had such big demand. Very well balanced group surprisingly between genders and other diversity metrics. Because I think there's a stigma around capital allocators that it's male dominated, Caucasian field, mostly out of Silicon Valley, and that's not the people who showed up. It was in Miami, and there's a lot of love for Miami, and there wasn't a lot of love for Silicon Valley there. Everything from tax rates to the local politics coming out of California, etc. And so the All In Summit, I recommend. It is a summit you have to apply and be accepted into, and it's not cheap, but it was definitely worth it. I'll be going back next year.
So what has changed in your approach when you're thinking about raising money as a CEO in the 2022 June, July, summer coming up based off of what you have learned?
Well, yeah. So a number of the conversations were around a form of resetting when it comes to capital allocation, venture capital in particular.
What do you mean by reset?
So valuations are now suppressed in the public market as liquidity is being drawn down in order to combat inflation, right? So I think one of the things they talked a lot about is for every dollar of stimulus that was spent, 92 cents showed up in the stock market. And so basically people didn't need the capital, especially on what we're seeing on the second tranche. So the one that was under Biden's administration. So basically retail traders like Robinhood and others were getting in, liquidity was high, and you had a number of people who had newfound wealth, at least on paper, pushing capital into new things. And that capital wasn't backed by anything. That was just printed money. And
Right.
so once we start going down on inflation, and what's interesting is since so much money went into technology, I won't get into all the economics here, but technology is deflationary because like it introduces efficiencies into the economy. So it needs less money to do its thing. And it's not a capital intensive as opposed to like biotech or something like that. True software technology doesn't have that same. It's by creating this environment in which interest rates rise, we're pulling liquidity out in the marketplace. The Fed is also getting out of quantitative easing. And so what we're seeing is a number of people saying, all right, button down the hatches. This is the right type of correction. Now, I didn't hear any capital allocators say that we shouldn't be doing this. Right? Nobody was defending 8% inflation. Every capital allocator we talked to said, this is the time that the real businesses show up. This is a great opportunity for people early. So if you're a seed or series A company or venture capitalist, this is a great time for you. You're going to get nothing's on sale, but you're going to get, instead of having to do 40, 50, 60 ARR on term sheets, you're going to see more reasonable 15, 20, 25% or 25x ARR. And that's going to give you somewhere to grow. So as you hold on to it in your portfolio for 8 years, when the economy allows to heat back up, and hopefully that heating back up is just from natural GDP growth and output, you'll start to see multiples get back into the SaaS publicly traded companies, and because that's what's driving everything. So
that's perfect, right? Because I'm investing in early stage cyber, right? And it was expensive, and now it is reasonable. And I can look back at my LPs. I can look at the people who are investing in my fund, and I can say, good news, guys. I'm buying low right now. And the cyclical nature of markets mean in 5 to 7 years, there's going to be a natural uptick, and we're going to ride that ride. It's like dropping into a wave in Hawaii on a surfboard. I'm joking. Every time I do that, I like get plowed and like drug across the sand. So that's a bad metaphor. No. Let's move to a different one. Like dropping in on a skateboard on a half. No, that one's a bad too. I crashed my head with. Anyway, let's say that you're just got good timing, right? And that's what this is that those of the investors who are bold enough to deploy capital into the right kind of assets. And what I'm hearing you say is that tech is a great asset to be deploying into, a great vehicle to be deploying into, because, we can produce results cheaper than needing to like, oh yeah, we got to buy 7 manufacturing, factories, et cetera, et cetera, et cetera. So that's pretty cool. So that was your big takeaway, is that, this is a great time to be a Series A seeking tech company, because you can offer amazing deals to, those capital allocators who are going to look at you. And you can say, guys, if you get in now, the natural way that the market's going, you're going to have a better shot at returns. So this is actually the least risky time to deploy capital if you find yourself a good company.
Yeah, that's a big if. But here's one of the things that's interesting, right? Once venture capital raises funds 3, 4, 5, etc., their returns go down. And their returns go down because they do a couple of things. One, they try to institutionalize their secret sauce, right? So they try to bring in new juniors and the like, and they try to say, okay, this is what we look for. We've done all this research. We've gone back and we've codified our intuition this way. And so that creates a weird filter process for the deals coming in anyway. And then on the other hand, what most people it's kind of like showing up at the casino. If you're a new roller and you've never played craps before, like get out of their way, put dice in their hand. It's going to be a great night. The first time GPs out there usually show up at the table with already having 3 to 4 deals. This is one of the articles I sent you.
Yeah.
Already. And you get outsized returns on your first funds, 1 and 2. As the GP is new to the block, they're figuring things out. They're willing to move and stretch their resources and capital around. And it's just one of those very interesting phenomenons right now. So there's not only is it a good time because things are on sale. They're not really on sale. They're just priced accurately now. On the other hand, new funds in the space, if they're showing up with the right kind of mindset, they're going to eat the big guys' lunch all day in this space. So like I think of like Tiger Global announcing they have a Series A fund.
Mm-hmm.
Like I think they're just going to get demolished. And I think they're going to have trouble. I bet you folks like Tiger Global, and I hope this doesn't get back to them if they like me or not. But I think Tiger Global, I think Alameter, I can never say their name right. A few folks like that are they're going to be in trouble, and they're probably going to start giving money back to their LPs, because like when an LP commits at that level, they don't actually wire the capital. They just send an IOU.
Yeah.
And
until
then,
the capital call.
Yeah, until the capital calls, and those capital calls only come when investments are being made over time. But I think you're going to see a number of these people as they reset, because they can't play this game early well. They're going to just start pushing money back to the LPs and say, we'd rather have you on the next fund, but this is not the right time. So I think you're going to see some of that behavior as well, which is going to be very interesting. So the hypothesis is that Anzus Capital is at a great spot because you're showing up at the casino with new deal flow, new point of view, and things are price market.
Yeah. It's interesting when you tell people what you're trying to do and you have a background in what you're trying to accomplish. I don't know if I'll ever create a really good cybersecurity fund after this first one, because I'm putting it all out there. Like, this is the magic sauce. This is where I see the connections. And I'm giving myself permission not to have to do a second fund.
Yeah.
And maybe move into a different kind of industry where, I think that you've got a shot and you take it. And those who don't invest in, first time fund managers don't get to take advantage of that. So, yeah.
And I think it's possible. There's some funds that have gone well and gone upstream, and they continue to do well. But the seed and Series A people don't have to know the investment banks, don't have to know the IPO folks. They don't have to navigate worlds of potential SPACs, etc. So they don't have to have these large exhaustive networks of their other friends from Harvard, right? What the seed and Series A people get to bet on are a true empathetic understanding of the founder in a close, if not true, empathetic understanding of the problem and solution. And so they get to bet on those things matching. Right. Where, there are upstream capital providers who are also like, well, is this founder going to present well in front of a board of directors? And how do we make sure that in my estimation that this team has enough combined experience to be able to go to a unicorn status, etc. And those are not the questions seed and Series A people ask. They might think about them, but they don't ask those questions. They care about the founder and they care about the problem and solution.
Yeah. So from my point of view, and you've heard it from me, I was like, not all CEOs not all founding teams are meant to go the entire thing. If your genius is going from 0 to 1 and you're great at early customer adoption, but the idea of systematizing for scale and de-risking and building bureaucracies inside of your company. If that's not your genius, then oh my gosh, why in the world would you want to keep doing that?
You know, one of the things I found very fascinating, right? Because that's usually the case by Google, right? Sergey and others, they brought in Larry, they got out of the way, right? They said, not our genius. I did meet a CEO who is one of the latest unicorns to come out of the Southeast. And the amount that the company has to do to surround and protect themselves from the CEO is pretty amazing. And like but when you have extra capital in the system, this guy just came off of raising another 200 million. When you had 200 million in liquidity around you, you install enough VPs and C-level folks around you in an organization of 3,000-4,000 people, to make sure that the initiatives you work on are 3-5 years in the future, right? And they've got this guy chasing all sorts of rabbits, and he loves it. Yeah, he thinks the rabbit chase is his idea. And I was just listening to him talk. I was at the conference actually, and he wasn't on stage. We were just talking at the event, and listening to how far away the stuff he's working on from their core business practice is. I thought he was very excited the fact that he had freed himself from that. But I was just sitting there thinking, I was like, I bet you like the vice president of growth loves the fact that you're not in their business.
Well, yeah. And I think that's the way it's supposed to be, by the way. I think that, I mean, what a wonderful arrangement. The founder CEO is happy. The company is growing and running. The people who are handling tactical growth don't have the burden of excessive ideation. That's what I call when the founder sits in the room and says, what we can do, guys? Like, we could just follow the plan. This is what we could do. I remember it was probably, 9-10 years into running my company, and most people were doing the things for me, and I didn't actually know what I was supposed to do. So I would be just walking around the office talking to people, because that's what a good manager does. Management by sneaker. And what I was doing is interrupting literally everybody for about 5 to 10 minutes every couple hours, destroying productivity. Got to the part where they're like, what would be great if you would go to an early lunch and then not come back. I was like, guys, I roll in like about 8:30 and you're asking me to leave at 11. They're saying 11's when the restaurant's open. You probably need to leave at 10:30 to make sure you and there it is, right? And it doesn't mean that you're out of everything. When you remove yourself from that kind of thing, you still have to report to the board. You still have to make sure that you still have to CEO. It's just that you get to CEO back into your genius, which is seeing things, connecting dots, and that strategic thing. I love that. That was a great story. I mean, he's happy, they're happy, the investors are happy.
Well, that's the idea of firing yourself is you can still get a paycheck from the same organization and then be fired from founder level hustler activities, right? So, yeah.
Man, someone should write a book about that.
I know, right? So what's on your mind? What is the thing that you want to go today?
So I came back. I've been feeling really bad about venture. I've been feeling like maybe venture is stupid. And I've been trying to justify the sheer amount of money that needs to be deployed into these almost speculative seed investments and Series A investments. Series A, hopefully a lot less speculative. Versus these people who are absolutely thrilled with buying an already successful company, tweaking the marketing a bit, and jumping it from 3x to 6x and selling it over the course of 18 to 24 months. And I'm like, and like real estate and so it's like, what is the role of venture as an investment vehicle in all of this? And I began to really figure out that it has a lot to do with what the investor, what the LP wants out of the world. And I've kind of broken it into fast capital and slow capital, where fast capital is I want to deploy my money. It needs to generate cash flow while my money is deployed, and I need it back in my hand, within 24 to 36 months, 2 to 3 years. 18 months would be better. And then slow capital, to me, I said, well, then what's the point? Because fast capital sounds great. But what I've discovered is that fast capital doesn't really change anything on the earth. It's a way of making money. And this is my opinion. And of course, there are exceptions to all this thing. But it's like the slow capital. It might take us 10 years to develop this way to keep water clean. It might take 5 years to develop this new technology on how the human brain works, and might. Fast capital doesn't work really, really well in big problems that need to be solved. Mm-hmm. And so the thing that I have been curious about, I've been putting some of the stuff on LinkedIn. We had a good conversation up there where it is, what's better, fast capital, slow capital? No, the truth is that they're neither better or worse. They're both part of an ecosystem of financial vehicles. It's what does the investor want? And the ones that I am bumping into that are real estate investors, they love fast capital. They want, go buy an e-com, grow it, sell it, go in at the invest in a company that is ripe for acquisition. Let's go. And then when I bump into folks who seem to be, I don't know, a little bit more comfortable in their wealth, where they're out of the rat race, where they have, a percentage of their wealth and they have a mission or a legacy that they want to participate in, and they care about seeing big things happening even after they have passed off and shuffled off this mortal coil. So that's I am trying to figure out, how do I quickly identify what investors are investing in what kind of capital? Because I need to either hand them over to the private equity guys and show them the deal flow we have over there, or invite them over to the venture. And I just keep finding fast capital people. It's very, very difficult so far for me to figure out where are the slow capital people and why are they investing. So that's what I'm struggling with right now. And I think that's what most seed venture folks are looking for. Is like, how do we find the right kind of investors who've invested in the right kind of venture funds that are comfortable with slow capital, and particularly the way I'm going about it. Mm-hmm. So yeah, I would love to have you help me sharpen the knife on that concept.
Yeah. Well, I think, philosophically, it's right on, because that's time value of money is everything, right? The day laborer wants the distance between their activity and their payment to be at the end of the day, right?
Sure.
The salaried employee wants the distance between their labor and their payment to be no more than 2 weeks, mm-hmm. right? And so how far out do you start stretching the effort and activity from the return? And along that way, once you get to levels of investing, you have the ability, excuse me, along the way, you have that ability to pull profits out, make some sort of return, or mm-hmm. to maximize profitability to an extent that somebody else who wants to pull capital out of it is willing to buy and acquire you all, right? Whatever it is, there's just like, hey, if profits are the focus, you can make that the focus. The interesting thing about slow capital is has this ability to solve large strategic problems, mm-hmm. and it allows for capital to continue to go back to that problem. Right. Yes. So as any profitability or anything comes from it, the money goes right back to it. Like the most successful case we have for that today is Amazon. Right. And, people in the fast capital world mock and continue to mock Amazon for having like 11 years of not having any profit. Like, you are a company that on every single unit economic, every transaction you all make, you buy it, and then the difference, and there's margin. There's money in each transaction you make, Amazon. How come you can't make money? And, because Bezos and other people are like, no, all of that profit into our warehousing, all of that profit into our backend, all of that profit into increasing leverage and getting things like Amazon Basics in order. And then this over here, and then an international warehouse. And then how do you solve a problem we're solving, which is everybody in the world is 2 days away. Everybody in the world, that's so crazy, 2 days away from anything they need.
It's weird.
Like,
That's
and
slow
he-
capital, baby.
and he made FedEx and UPS and USPS and even DHL up their game to get their business with him. It was a force multiplier. So he solved that problem. Now he's the richest man in the world. But that's 20 years of work.
Well, and the other richest people in the world who are buying all did slow capital plays that disrupted and created new markets. It's that whole blue ocean strategy thing, right? It's Bezos took 20 years. Elon took however many, right? It's slow capital sets. So in my very fancy LinkedIn post, one of my thoughts is that it's not either or, it's a cycle where the slow capital sets up the opportunities that fast capital will participate in 10 years from now.
Mm-hmm.
And
that's fair.
Yeah, and the value of being part of the slow capital is that you get to have access to all of the early opportunities. You get to ride the wave. You get to do so I find myself having to do some lying to myself over the last couple of weeks. And the lie I've been telling myself is that people who only invest in fast capital will never make a giant change in the world. They'll just create more and more wealth. And then they'll say they're going to do something with it. But what they do is they just redeploy it again to create more wealth. And slow capital people are the people who are in it for changing the world and And so I've been strutting around feeling superior because I'm attracted to slow capital. And while I like fast capital, because who doesn't love cash flow and money, I've found myself trying to force me to feel like I was better than capital allocators who are solely focused on cash flow and quick turnarounds. And that was more something unokay about how I felt about what I was doing than necessarily what they were doing. And that's been an interesting journey to see how I have to identify to stay in slow capital world when I'm not getting a lot of positive feedback from investors that anyone seems to care. And that's probably because I'm talking to the wrong people.
Well, yes. I think it's very interesting working with LPs in particular, because the difference between giving their money to an allocator, VC, PE, whatever it is, they're giving their money to somebody and saying, go make bets. And let's say they pick A and B, they have a choice between A and B. A goes out and deploys all their capital and spends 10 years working hard and nothing happens. No real return. They bet on B and same 10 years they go out and do it. The allocators A and B both have the same enthusiasm and they both spent 10 years.
Right.
But one of them essentially, spent 10 years with nothing happening.
Yeah.
So the question is, fast capital can be a way to get a feedback loop to make pivots and adjust, because this isn't a buy and hold, leveraging new market tax credits or anything like that. This is so one way that the allocator themselves can say, like, I don't want to waste 10 years figuring out if I made the right bets.
Yeah.
When, 8 years ago, did I make the right bet? The capital allocator says, I need to make sure that I play in both worlds.
Correct.
And so, yeah, that's the 2 and 20 is supposed to help that out with management fees, but that's typically not enough to actually support where that capital allocator needs to be and where they need to be working. And that means that they need capital to access networks that are different than the 2 and 20 carries. So they also themselves in your funds, you find yourselves having to do this short-term plays, these flips, these other things to generate the capital needed to make the slow work. So I think we're both seeing the same thing. It's just a very interesting.
Well, and it shows up in how you set up your firm, right? And so I've got a slow capital cybersecurity fund that is very Series A bridge, seed bridge Series A focused on cybersecurity technology. And we've got about 80% of our deal flow and 80% of our LPs are interested on the private equity side. So, in order to keep the actual firm alive, we have to do fast capital deals to generate cash flow. And in order to make it thrive, I do the slow capital venture side. And to me, being able to combine both of these and not have something in the middle where like I identify as a VC and you identify as a PE and blah, blah, blah. No, if I'm Bob Ross and I'm painting, I want all the colors. I want all the options. And so the idea of create a firm, build a fund, run the fund, that doesn't work for me anymore. Now it's build a firm, attract amazing limited partners, find out if what we're dreaming about the future matches with what they're dreaming about the future, and how we can actually produce wealth matches with how they want to generate wealth. And then we all come together, and we have no structure in place until we've had all those conversations, and then build the amazing thing that meets the win-win-win for the investor, the fund manager, and the entrepreneurs that we're working with. That's where I'm living. And it only took me 12 months to figure out that I was doing it a little bit wrong. And to me, that just sounds smart. But like you said, it costs money to go and do all that networking. It costs money to show up at the right events. It costs money for the travel. It costs money to wine and dine. It does all of that stuff. And so it's relieving in a way, because I give myself permission to be curious about the person in front of me, rather than feel like I have to push so hard to sell the vision of what I have for the future, and they better buy it or they're dumb, right? That was an unhealthy place I was for a very long time.
Yeah. So let's talk about the big problems that people have solved before. Like every company out there is solving some problem. Like, I think it's interesting. Like McDonald's is solving real estate problems, right? Real estate ownership and holding problems, and producing income for that, like, or 2-day access to anything in the world with Amazon or what have you. And there's like Musk, Elon is out there trying to save humanity and a few other things, that whatever horse he's riding, he's trying to solve those problems. Like you talk about Anzu saying, "Hey, we want to end cybercrime." And you even have made it a SMART goal. I think you had like a date in mind, but the
30 years, baby.
30 years is all cybercrime. Like, but what's the problem you're solving then? It's not a crime problem. It's a crime prevention or a deterrent problem.
It's a trust problem. So the problem so we're talking about the big problems that people are solving. And I really thought you were going to lead with erectile dysfunction. I was hoping you were going to lead with that, because I had about 7 puns that was ready to go. But I get this is an adult program.
Yeah. Sorry. Yeah. We're not blue pilling this. We're red pillars, right?
Very well. Nailed it. So
there's some controversy for you right there.
This is going to spiral so fast if we don't get it. Okay. So why eradicate cybercrime? Why is that the big thing? Well,
no, not what is the problem you're solving with it?
Right. Well, if you unwind that, the problem is that as our trust erodes between humans and our interactions, society will burn. When I no longer can trust what I see on the news, or what the person next to me is saying, or what or even the trusted communication platforms that I leverage to communicate back and forth with loved ones, if I now have to be suspect about every single data point, and I can no longer trust, I slow down society's evolution, and eventually it just atrophies and dies. If you look at Rome, if you look at all the empires that have burned, it's because corruption and lack of trust in officials. And so, well, that's a bit harsh. I'll just say that there is a systemic breakdown of trust. And so that's the problem that I'm interested in. I'm interested in how do we build healthy societies where people can do business with each other, people can have relationships, people can meet new people and trust them rather than not trust them as the default. And to me, one of the ways I can do that is handle my very, very small part where I can make sure the communication channels that we use are as resistant as possible to manipulation. So, that's how I think about it. And, but it's not, I don't think I'm drifting the direction that you wanted to drift.
No, I think it's interesting. Yes, you're okay. So if your fund solves the ability to protect the integrity of all communication out there, that what the sender and the recipient are getting are fully their the integrity is intact. There is no manipulation occurring between those two. I think that's very interesting, because part of the reason. Well, I'm trying to connect dots that are helpful here, and not just social dot connecting between like new types of tribalism and ideologues, but how do we actually move that? So when you put capital to something, you say, hey, we're putting capital to the things that protect the integrity of our communication.
Mm-hmm.
And therefore, by doing that, that's the first order. So the second order is we actually solve the trust problem. Now, you might not like what somebody says if you're a recipient, but you can trust that that source said it in that way. Like you get both direct and indirect context immediately, and you know exactly what's happening. I think that's absolutely worthwhile, right? And so that right there is a combination of technology and psychology, and perhaps philosophy as well. Like we are still wrestling with a number of issues right now where, call it the critiques out there on, how can everybody read the same news article and draw different conclusions on what's happening.
Mm-hmm.
So, but those problems are worth solving, right? That's not one we throw our hands up in the air. We say there's a way to solve it, even if it is to embrace all possible interpretations of any text. Like, I think that's I think it's worth doing. And what I find interesting is that would be to go back to the point, that would be an extreme slow capital, right? That would require a level of self-awareness for us as humans to be able to study ourselves and understand how we're being manipulated by ourselves.
Yeah, I love the idea that being clear about a problem you're solving gives you the freedom to come up with interesting ways. Because when I say I want to, solve this problem about trust, I didn't say I'm trying to start. I want to fund a bunch of cybersecurity companies. It's kind of where we're starting, but that's not going to work. There's this great TED talk about advertising, and this Brit was basically saying, "Look, we wanted trains to run faster between this city and that city. It's a 3-hour train ride. We invested, $7 billion into the train infrastructure, and now it is a 2-hour and 45-minute." It's like, for those billions of dollars, I could have given everyone a free glass of champagne and hired a train full of supermodels to give the champagne out for 10 years. And no one would care that it was a 3-hour trip.
That's right.
Right. So the solution to all of this, to me, is creativity and humor. It's when I have two people who have absolutely different points of view, and they're laughing and they're hanging out and they are feeling good rather than having their defenses up. To me, that is the secret. The secret is safe places where people get to have open and honest conversations. And I feel like building these funds is a micro experiment with that, because if I can't create a safe place where somebody who has wealth, doesn't want to lose their wealth, and does still want to invest and change the world for good, if they can't know, like, and trust the fund manager, if it's just spreadsheets, I don't know, man, that doesn't sound right to me. There's something that seems off.
Yeah, and that's one of the interesting things. I think that um, we're still seeing play out in the marketplace. Okay, so let's think about this generationally. It's not always helpful for me to think about like boomers versus Gen X versus millennials, etc. But what is the nature of money to the people who hold capital right now, right? To
That's a
the
good
boomers
question.
and the Gen X.
Yeah.
And what do they believe you see and don't see, right? And to boomers, uh, money is something that can be created, but it's got to be spent and used pretty quickly,
Yeah.
right? So boomers, they they have been known. So I think there's a misconception that as you get older, you're more likely to vote. Boomers have been voting in a strong block since they were in their 20s. Congress looked a lot different like during the time of Reagan. In the 80s, it was much, much younger because boomers made it younger. Boomers have been voting their interest and their needs this whole time. So to hell with everybody after them, they are printing and spending money. That's just what they do. Don't touch Social Security.
That was actually in my wedding vows. That exact line.
You're a Gen Xer, right? So Gen X has an interesting relationship too, where you've been trained and you looked up to boomers when it comes to money management, right?
Yeah.
And so what money is something you got to spend because it's going to go away. So you have fast capital people in the boomer seat. And now you have slower capital millennials coming along saying like, if I can invest longer and I get the lifestyle I want, if I can make a difference in social needs, and you've raised like the next generation of capital allocators and holders are very interested in cool tech, but only if it solves actual problems, right? You don't see a lot of millennial capital allocators saying like, we need to get AI because we need a better marketing tool, right? What they say is, we need AI in order to solve this education problem or this access problem to healthcare or this, what have you. And so I think it's very interesting because if you hang around people who see the future and are the future, you're going to want to have this slow capital mindset. You're like, man, that's super sexy. What if we did take, this Web3 stuff and apply it over here? But you're talking to younger folks. Then you go talk to older folks and they go, well, you'll never see a dime of that because the distance between your investment and your return needs to be as small as possible because there's too much risk. And if you can't do this, this, and this and manipulate the outcome, then you're out. So then you got to like convince these folks, which there's only a handful, like the Richard Bransons of the world. You got to go to them and say, to hell with everything. Can I get you to put money into this millennials and next gen slow capital plays?
Yeah. I'm going to put words in your mouth. This is a direct quote from Zach Eikenberry.
I endorse it, and I said this.
Boomers burn money like crazy, and they're all fast capital. And an addiction to fast capital destroys society if you do not also invest in slow capital. And then, no, I'm not done putting words in your mouth. So I'm making it very long.
It's worse than that. I think they burn capital by throwing it through real estate. And so,
yes, even okay.
So like, I think they take a limited resource like real estate and they take outside capital, they put it in, they inflate it up, they think they're adding value when they're not. They're just creating more scarcity by the buying act themselves, and they continue to print freaking money. So like, to hell with baby boomers who also own large swaths of real estate. And now they're putting money into these hedge funds who are buying up residential. And that's just a pet peeve of mine. So,
all right. Well, I think we got your hot take. You also said that Gen X is grew up watching the boomers burn the money. Like I grew up watching my parents be really, really bad with money, and they didn't get their act together until after we were gone. They're like, oh no, we should probably fix this, pay off the credit card debt and do all that stuff.
Yeah, that's an unended, but they voted as if they never voted against their own economic interest.
What, the Gen Xers or the boomers?
Yeah, boomers.
Yeah. Well, so, and I believe that Gen Xers are both fast and slow capital. And then if you move over to millennials, they see the world is on fire and the only way to fix it is slow capital, because they think, well, I can't buy a house anyway. The world is on fire. The only way for me to have a good life for my children is if we roll up our sleeves and we change things. And so if I am building a fund and I am courting LPs, I should find high net worth or institutions ran by Gen Xers or millennials, and I should keep away from anyone who is being ran by a boomer. That is that's just I'm looking for to oversimplify things.
Yeah, so like there is a counterpoint, a counter set of data to some of the things we're talking about, which are there's still speculation out there among all generations. So yes. You do have millennials and younger now have an easy target on their backs when it comes to crypto, right? Yeah. And so you have speculatory activities coming along, and some of them are flat out fraudulent. Sure. And they make the case for the older generation as to like why you guys are being silly, right? Like you guys think that fiat currency is not, boomers are like, if you don't like the way fiat currency is, you're a couple votes away from influencing the Fed and you can change it any way you want to. Just follow us.
I know the way. Come on.
And I think Gen Xers are like baby boomer light in that regard.
Shut your face. Like, do I feel like I could buy politicians and manipulate the thing?
You guys aren't fussy about things like Medicare. You're grateful it's there and you're counting on Social Security. But like the difference between Gen X and millennials counting on Social Security is the stark breaking point. Millennials don't. Gen X is like, yeah, it better be there, but it can't be my only thing.
Yeah, it might be there. Yeah.
No, millennials do not believe it'll be there.
They better keep paying it.
but yeah, that's right. But the crypto bros and then the other speculative. So there was too much money the last 2 years in the economy. That's just the bottom line.
Yeah.
And that's in a lot of ways it's because there was just too much uncertainty when you introduce a pandemic. So the government and political establishments just said, hey, we've got to flood everybody with some sort of security out there. And so stimulus checks and everything rain. Well, the other issue is that the market's flooded with liquidity and day traders. You saw meme stocks rise. You saw Wall Street bets. You saw
GameStop, bro.
GameStop, AMC. Hodl to the moons. And what I think is my counterpoint is like that showed that there are people within generations that also can't be trusted with good monetary policy and capital allocation. So we do have a problem right now that there's a handful of capital allocators out there, and I met a few. Excuse me. At the summit I went to, I met a few capital allocators who made money on margin calls, option swaps, and crypto in the last 5 years. And they believe because they made those calls, they understand where to put capital next.
I love that. That's
not a positive sign. That is not an understanding of the larger social trends. That is being able to look at graphs, distill something down, and make fast capital.
Then I misheard you. What I thought you were referring to is that because they were active in there, they were better prepared to then diversify and move. And what you're saying is they have a skewed vision of how society functions, and they're only on their lane.
Let's be clear. I'm a slow capital advocate. So like when I see people marry fast capital returns with the fast capital, and I'm not saying it's the only source, but I'm saying like I'm a big fan of the social capital movements, the idea that it's worthwhile to fundamentally solve using technology, education access issues, etc. So the point is, I was making this. I was, I think I can say this. I was shitting all over baby boomers, right? And
we're not going to do an infographic of that, but yeah, you can say it.
a little stick figure, like
this is like just one bird, just sitting on like a bird on a wire, crapping on a statue.
And baby boomers are the most philanthropic, generous generation to ever existed in human history, full stop, period. They've given more money to nonprofits than any other generation before them can even touch. And they dominate. That's a reason we have as many nonprofits as we have and philanthropies as we have, because baby boomers.
Mm-hmm.
So they're calibrated that way, but they're also calibrated towards, I think they have a false sense of holding when it comes to real estate, because they view those as fundamentally liquid solutions. And so they don't actually hold value. They trade them. They trade them like baseball cards. And so the real estate thing aside, baby boomers, I was taking a dump on them. But what I was saying was, when baby boomers look at us and say, like, why should millennials get any capital to be able to allocate around? You guys are going to be slow capital. You all think you can change the world. This money's just going into solar, and that's stupid. Like they go, hey, why are y'all doing that? And the people who are making fast capital right now and are in the millennial generation and younger, right, are these people who did it, and maybe they were prophetic. Maybe they are the smartest ones of our generation, but they quickly spun up a whole bunch of things around things like I said, the crypto, the meme stocks, etc., the day trading retail folks. And I don't understand the sustainability. Maybe that's my point, is I don't understand how that fast capital moves to slow. And now all of a sudden I'm walking around like having to defend peers in capital allocation circles. And I'm like, I don't know. They called an option on Tesla when it was down.
Yeah.
And now they're worth 80 million. Does that mean you should give them more money? I don't know.
Well, they're really leaning in. Would you rather be lucky or good? And I'm luck all day, but lightning tends not to strike, in the same place all that often. And unless you build a lightning rod, and then it does it a lot. Anyway, again, I'm just crap for metaphors today. But speaking of being crap, I think we should wrap up, because I feel like we could probably go on for another half an hour.
But I wanted to hear your points. I want to hear your reaction to my generational rant today.
Oh, I agree.
Do you even understand what two stones means?
Well, no, I put words in your mouth already about boomers being fast, Gen X is both, millennials slow. And you then counterpointed and said that inside of each of these generations, there is a variance, and they're not all like that. And but there is a push and pull where, by the way, the thing that I don't think you mentioned is that boomers is about to die and millennials have a long way to go. And so how they choose to allocate money, and the way that boomers allocate money to do good in the world, you mentioned, was they give to nonprofits, and they have doing good separate from profit. They have one bottom line, profit. Then if you want to do good, you go work with a nonprofit, where millennials and Gen Xers are all about the triple bottom line, or the quadruple bottom line, where you can have impact capitalism, you can have social entrepreneurs, you can have conscious capitalism, you can do all of these things, and you can do good while raising money and deploying the money and then generating the capital, again, generating cash and returns. So yeah, that's my take based off of what you said, is I agree that there are, what are they? Psychographics? What's the one? What are we talking about here? Psychographics?
No, when it comes to age, it's a demographic.
Okay, so the demographics have real trends that we can look at. And if you are a fund builder, you should know what you have built and who is it going to match best with, and then go talk to them. Because I remember I spent 3 months in Boulder, Colorado, had a slow capital company, and I was talking to fast capital, investors, and it just didn't work. So save yourself a lot of headaches if you are know what you're building and know who wants to invest in it. Because I'll leave you with this. I was talking to the CEO of Spire Satellite Company the other day. He just finished his Series C, and he was talking about the three little piggies. It's like, hey, And some companies build straw houses and they go up and they go down real fast. And some of them are great. Said, you cannot do a space company. You cannot do a deep tech company. You cannot do a company that's going to last for a long time and have real change unless you take it slow and build the brick house. Be the third little piggy, do the slow capital if you want to have real change in the world. And I was like, oh yeah, that felt good because it agreed with the way I was thinking. And that always feels good.
It's good to find out you're right.
Yeah, you know what? I have a real gift to ignore data points that are contrary to my way of believing the world works.
Yeah, I'm also good at confirmation bias. It's like the thing you just confirmed to me. I'm really good at that.
You are good at that. And so am I. Is this an echo chamber? I feel like we're just bouncing back and forth.
Oh, man. I like your echo chamber. I echo that. That's right. Exactly right.
All right. Well, we have 2 seconds. Can we get a third? Great. And the motion moves. This is how politics should be done. Just us riffing. There you go. 2 birds are not what we're doing here. It is 2 stones, 1 bird, where we focus way too much on a lot of different things. I think today was a 2 birds day, though. We covered a lot of ground. We went a whole lot of places. We maybe didn't bring enough stones to this particular podcast. It was way too many birds. So, yeah, as always, Zach, fantastic to hang out with you.
Can I make a comment? I did invite somebody to join us on the 2 stones, 1 bird. Yeah. And then he immediately thought like, oh, you mean stones, like, stones, like
balls.
That guy has that guy has stones. And I was like, I don't not mean it that way. That wasn't where we went originally with the name for this podcast.
Well, I remember the original idea you had that I immediately vetoed. 2 beans, 1 stalk. I was like, Zach, dumb. I don't care if they're magic beans. I don't care what your wife says.
Oh, you're gonna make me COVID all over the place. Stop.
Oh, there you go. Anyway, that's what it sounds like when a founder of a tech company and a venture capitalist who's investing in that tech company have an hour of uninterrupted tomfoolery. And you're welcome. We'll talk to you again soon. Make sure you join us on our LinkedIns and do all the things. Bye.
Bye.
Hey, and thanks for joining us for the TSOB podcast. Find us on LinkedIn and give us your hot take. The whole reason we're doing this is to get access to better conversations that help us up our game. And if you have something you want to share, we want to hear about it. Find us on the TSOB LinkedIn group and jump in with 2 feet. We can't wait to chat.